Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in.
Okay, happy Friday everybody. The weekend is almost upon us. I hope you have all had a productive week. Just a heads up at the beginning of this video, today's episode will be very economics heavy. 2 quick updates before we jump into the main stories. First, touching on what we discussed yesterday, after 2 weeks without any appearances, General Secretary Xi Jinping has once again re-emerged in public, at least according to state media. State-run CCTV reports that he has been on an inspection tour in Urumqi this week, which could explain why his movements were kept out of the public eye in the lead up to that trip. And the second quick update is a few hours ago, Sri Lanka's ambassador to China told media that the crisis-hit South Asian nation is continuing negotiations with China for as much as $4 billion in aid and is confident Beijing will agree. The $4 billion includes a loan of $1 billion to repay Chinese debt coming due this year, a $1.5 billion credit line to pay for imports from China, as well as a $1.5 billion currency swap. Okay, now for the main stories, and of course the big news is the Q2 data for the Chinese economy. Today, Friday, the National Bureau of Statistics published the much-anticipated official GDP data for the 3 months through June. That is the second quarter of this year, and even the official numbers were not good. We are of course not surprised by this. The second quarter saw the devastating Shanghai lockdown, global disruptions, and an ongoing housing crisis. This also explains why the last 3 months of China Update videos have been quite pessimistic on the economy side of things. China's economy expanded by 0.4%, the weakest quarterly expansion since the coronavirus pandemic first hit the country in Wuhan in early 2020. Quarter on quarter, Q2 saw the economy contract by 2.6%. This growth rate was worse than the 4.8% year-on-year expansion seen in the first quarter of this year, and well below economists' already low expectations. For example, last week economists at UBS Group AG told investors, quote, Q2 GDP growth likely slowed notably to between 1 and 1.5% year-on-year, given the sharp COVID hit in April and slow recovery in May, end quote. Analysts at brokerage Huatai Securities Co. Limited also estimated 1 to 1.5% growth in the second quarter. In the first 6 months of the year, these are the 2 quarters combined, GDP grew at 2.5% year-on-year. With the release of the official data, a spokesperson with the National Bureau of Statistics admitted that the economic situation is concerning, expressing, quote, the downward pressure on the economy has increased significantly since the second quarter. The foundation for sustained economic recovery is not stable. End quote. The National Bureau of Statistics reported provincial GDP data as well today, showing that Shanghai's economy contracted 13.7% in Q2 year-on-year, with Beijing's growth contracting 2.9%. Of course, we need to look behind these headline numbers. While the growth rate is painfully slow for a country at China's stage of development, some are likely wondering, with everything that happened in Q2, how was there any growth at all? Well, obviously, some analysts believe that the data has been massaged somewhat to show some positive growth, but even if the numbers were accurate, as we have been following these last few months, the growth has come at a tremendous cost, and that cost is massive local government deficits and surging debt. Before Q2, Beijing had already front-loaded stimulus spending to support a slowing economy. Then, in late May, policymakers rolled out a stimulus package containing 33 measures and accelerated local government bond issuances to fund infrastructure investment. However, economists say that even with these trillions of dollars worth of stimulus, it is likely not enough for the government to meet its GDP growth target of 5.5% for the year. China's broad budget deficit in the first 6 months of this year widened to a record as government spending climbed and revenue dropped. According to data released yesterday, by the Ministry of Finance, budget deficits for all levels of the government totaled 5.1 trillion yuan, or approximately $750 billion during this period. This represents an incredible incredible 600% widening of the deficit year on year. General public revenue fell 10.2% from a year earlier, but revenue from the sale of land use rights dropped even more, falling 31.4% year on year in the first 6 months. More on the housing sector shortly. There is also the concern regarding the quality of the growth. Quote, "For me, the most important story continues to be the deterioration in the quality of growth. For the first half of 2022, GDP growth was up 2.5% year on year, while retail sales, a proxy for consumption, was down 0.7%. Clearly, the consumption share of GDP is still dropping. Fixed asset investment, on the other hand, was up 6.1% in the first half of the year, driven by a 7.1% rise in infrastructure. What this means is that the sources of growth Beijing wants to see more of are becoming less important, even as growth declines, while the sources it wants to see less of are becoming more important. The consequence will inevitably show up in a surging debt to GDP ratio." End quote. And of course, we looked at this very issue, a surging debt to GDP ratio, earlier this week. Hey guys, if you're appreciating the video, you're enjoying the content or getting some value from it, don't forget to hit the like button. And for anyone who would like to go the extra mile and help me keep China Update sustainable, Patreon and Buy Me a Coffee links are in the description below. I really want China Update to be primarily supported by subscriber or supporter contributions rather than corporate sponsorship. So anyone who wants to go that extra mile, that's a tremendous help as well. As always, thank you everyone, all of you, for the ongoing support. Yesterday we discussed buyers of 35 projects across 22 cities deciding to stop paying mortgages due to project delays and a drop in real estate prices. Already within 24 hours, the scale of this issue has increased dramatically, increasing fears of financial contagion. Stocks of Chinese banks plummeted for 2 consecutive days as escalating refusals by homebuyers to make mortgage payments have spooked the market. According to data from HiThink Flush Information Network Co. Limited, bank stocks in Shanghai declined 1.69% on Wednesday and a further 1.54% on Thursday. Homebuyers are frustrated by stalled property projects being built by cash-strapped developers, as well as strong sentiment, especially in lower-tier cities, that properties have lost a lot of their value. Some buyers have also accused developers of illegally misusing sales proceeds. This is an issue that we discussed months ago, and it continues to be at the front of many property buyers' minds. Some are now simply walking away from mortgage repayment obligations. Yesterday, we discussed this happening with 35 projects across 22 cities, based on data available from Wednesday. Now we have fresher data from China Real Estate Information Corp, which published research yesterday claiming that homebuyers have stopped making payments on more than 100 pre-sold projects in more than 50 cities. Most of the delayed projects are in Zhengzhou in Henan Province, Changsha in Hunan Province in the south, Chongqing, a city in the southwest, and Wuhan. We all know Wuhan. Of course, this is very much squeezing Chinese banks that are already dealing with a crisis on the developer side, raising fears of systemic financial stress. On Thursday, yesterday, the China Banking and Insurance Regulatory Commission, China's top banking industry regulator, vowed to help local governments deliver property projects on time directly in response to this revolt from homebuyers. State media covered the announcement closely, stressing that the central government would ensure local governments, quote, guarantee the delivery of homes, end quote. This is quite the announcement. Also on the same day, more than 10 major banks issued statements saying that risks are under control. For example, the Industrial and Commercial Bank of China, ICBC, China's largest lender, said that overdue mortgage loans related to delayed projects only represent 0.01% of the bank's mortgage portfolio. Though Citibank argues in a recent research note that abandoned mortgages will reach at least 1.4% of outstanding mortgage balances. Many analysts agree that these are big red flags, but that the scale of this is still sufficiently small that regulators can respond effectively, pointing out that mortgage loans have been among the safest assets of Chinese banks, with the non-performing ratio at approximately 0.3% compared with 1.69% for all loans. But some also warn that financial crisis, much like a landslide or an avalanche, begins with just a few small movements. We will of course be following these developments very closely, as well as the housing crisis generally going forward. Okay, that is today's episode. Thank you so much, everybody. I'll see you tomorrow.